you were younger, because you're really old, they leave that part out, but you're really old, and when you were younger, things were easier.
That goes unsaid.
Yes.
What?
Well, I just said it. But anyway, things were easier. There was less competition. There were less hedge funds. There were less computers. There were less smart guys going into this business. I mean, when I got into it, I was telling Howard before, market hadn't gone up in 13 years by the time I got to Wall Street, so it wasn't a place that really was attracting lots of people. So they said it used to be easier for you, but you know, it must be harder for you. You know, hey, you stupidly wrote a book about this, and there's a lot of people doing this now, not just because of that, obviously. You know, it's harder for us. You know, you got the easy stuff. And so my response is this. People who are very good, especially in a special situation, I have two responses. One is people who are good at special situation investing, really looking off the beaten path for liquidations or recapitalizations or spin-offs or any of those things. Many of them are liquidity constrained. You know, Warren Buffett started making a lot of money doing those things, but he grew too big. And so I tell them that, listen, you know what happens to people who get very good at analyzing businesses in this area? What happens to them is they make a lot of money. And they get too big to stay in this area, so there's always a new group of people who can come in and look at some of those smaller situations, because the guys who are really good at it get too big to really take advantage of some of the smaller or more obscure situations. And so there's always room for new people to come in that area. And then on a larger scale, you know, because people still teach efficient markets, and they'll say, hey, you know, active investing doesn't work, and even Warren Buffett's saying go buy some ETFs or, you know, indexes and everything else. And what I'll say is that for most people that's true because they don't know how to value businesses. But I will give you a counter, and this is what I tell my students. And most of my students are around 27-ish or something like that. So I tell them all, let's go back to when you were roughly 10 years old, where you might start noticing some of this thing. And let's go look at the most followed market in the world, and that would be the United States. And let's go look at the most followed stocks in the most followed world, in the most followed market in the world, and that would be the S&P 500 stocks to a large extent. And let's take a look at what happened since you were 10 years old. Take a look at the S&P 500. From 1996 to 2000, it doubled. From 2000 to 2002, it halved. From 2002 to 2007, it doubled. From 2007 to 2009, it halved. From 2009 till today, it's basically tripled. That's my way of saying people are still crazy. And that's really unfair thing to say, because this S&P 500 is an average of 500 stocks. There's huge dispersion going on within that average between stocks that are in favor, that people love emotionally, and stocks that people hate. So it's really much worse than what I just described. There's huge dichotomy between things people like and people don't, things that are in favor, out of favor. Within that is all this noise is going on within that average. That average is smoothing things. So if you believe what Ben Graham said is, you know, here's fair value, and here's what the market prices are. It's like a wave around fair value. And if you have a disciplined way to value companies and buy more than your fair share when they're down here and sell some maybe if you're shorting and you're very disciplined. I mean, I make two guarantees to my students first day of class. First guarantee is this. If they do good valuation work, I guarantee them the market will agree with them. I just don't tell them when. Could be a couple weeks, could be 2 or 3 years. But I tell them the market will agree with them. And the corollary to that is this, and it's very powerful. I tell them in 90% of the cases for an individual stock, 2 or 3 years is enough time for the market to recognize the value they see if they've done good work. When you put together a group of companies, that actually on average is actually happening quite a bit faster. So, you know, both those are very powerful. It just says good work will be rewarded. So I don't think the reason people don't beat the market is because the market is efficient or even close to efficient or not emotional. It's very emotional, or that it can't be done. There's all kinds of institutional and agency reasons and tons of other reasons why they don't do it. But because prices are efficient, if you just pick up the paper or observe what's going on or listen to what I told my students since, you know, when they were 10 years old, it's pretty clear that people are still crazy and there's opportunity out there.